Good evening, my friends and the investors, especially new investors. Today, I am going to speak a separate topic very much related to equity market, buying back of equity shares. Now, what is buying back? Buying back of equity shares by a company means either by open offer from the existing shareholder, company wants to buy back in some proportions equity of the company for the purpose of cancellations, or buying back from the market. When it is buying back from the investor, there is a fixed price at which the company buy back. If it is from the market, then the company is to specify the maximum price at which share to be bought back for the purpose of cancellation. This is by law. Now, which company can buy back? Let's see. The company is having much of a amount of liquid gas in their balance sheet. Balance sheets are very healthy one. If you go through their balance sheet plus balance sheet, if the buying back suppose happened for the financial year 2019-20, then we must look into the balance sheet that is placed by the company as on 31st/3/2020, and we will find company balance sheets comprises huge amount of reserve and surplus, and we will find there is a promoter holding which is restricted to 75% now, so it should be below 75% because company law allowing promoters, that is the owners of the company, to have a maximum holding of 75%, not above this. So it might be like 50%, 60% or 62% held by the promoters in the company. Now balance sheet should be very rich. Very rich, I mean to say, current ratio of the company's balance sheet must exceed 2:1, which is standard one. It should be like 3:, or 4:1, or 5:1, because company going to utilize liquid cash for the purpose of buying back. Now company wants to make the shareholder happy, like instead of paying high amount of dividend, company decided to buying back its shares from the market or by the open offer in the proportions to every shareholder they held. That means company wants to suppose extinguish 5% or 4% or 3% of the patent equity, then whoever holding or held share into the company, those investor must be offered with the 5% or 3% or whatever, or 4% of their holding to surrender into the company for a fixed price. Price generally become higher than market price, obviously, because logic behind this, company wants to benefit the shareholders, and company also assures creditor, especially long-term borrower. That is, if you go to balance sheet, you will find the long-term borrowers are very less, obviously. They wants to assure the long-term borrowers the company will not fail to make payment of interest from time to time, or will not fail to make payment to the creditors who extend their services or sold goods to the company on credit basis. Now see, in balance sheet we must find the current ratio is rich enough, that is it should exceed 2:1. Might be 3:1, 4:1. Now current ratio means total of current asset divided by total of current liability. Now also we will examine the company balance sheet, it is having quick ratio more than 1:1. Quick ratio means total of current asset less closing stock, that is stock held on 31st say 2000 say and divided by current liability should exceed to 1:1. That means company is having a lot of cash or cash equivalent in its hand, and company wants to extend benefit to the shareholder. That is why buyback. Now see what's happened after buybacks. Now suppose company capital consists of 100 share only. Now if company had a buyback of 10% shares, that means now it's fallen to 90%. Now this 90% is equal to 100%. That means I held suppose 10% share. So my 10% remaining, if company bought back from the either from the market or it was to shareholder, I did not surrender my shares. So my holding continue as 10% only. So 10% out of 90 shares, that means 1/9 I held into 100. So automatically my this percentage of holding increased. So my share value should get reflected in futures, coming futures. Also, suppose for easiness, I take like company had only 5 shares, so 1 share representing 20% holding into the company. Now company bought back 1 share. So company after bought back or buying back only 4 share. Now this 4 share represent 100%. So 1 share represent 25%. That means if company bought back 20% share, that means shareholder holding will increase by 25%. So automatically you have like larger amount of share into the company after buying back by the company. Now what is benefit? Benefit is in future whenever company will pay dividend, then obviously each share will get more share of dividend. That means EPS become high, and so shareholder may expect more amount of dividend in coming years. Now we also find out sometimes company their balance sheet are not healthy, but still the company going for the buying back. There are some reasons from the management, like management want to reflect their shares price, like management want to reflect that company is healthy enough, it is having ability to reward the shareholders. So they go that means some clumsy pictures is coming upon the company wants to, or management wants to avoid that, so they go for buybacks. Now another reason might be that there is a like ESOP already there, and the CEO, other management, they are going to have ESOP at lesser price. So after buying back, the price will go up and they get the more benefit. That might be the another reason. Another reason, company wants to show the EPS in coming years as higher rate. That is why. Another reason could be for buying back. Another reason could be the company's management or the owners, they do not have mind. They are stupid in nature. Their mind is stupid. That is why they are acting slow and going for the buying back. Truly speaking, they are going for the buying back. Although the company is not in a position to have a buyback programs. So now the company's law in India has restricted, like if you are going for the buying back, you can make total amount of buying back, that cash utilization, you can do only total 20, it should not exceed the 25% of your total paid up capital and reserve together. So, and before that, prior to that, they have to have certain guarantee to the long-term borrowers. Then only company can go for the buying back shares. Now, okay friends, this is the only the educational parts. Although you have the idea of buying back program by the company, I want to say, especially the investor and my friends, those company, if their balance sheet are very much strong enough and they are going for the buying back, like as um, Crucible India, I spoken, Morganite Crucible India, that MNC, I spoken about. They had a buyback program twice in 2017 as well as 2019. So we can assume that, and we can go through the balance sheet of that company. They are healthy enough. They already had twice buying back programs, and now they are having the split. I don't want to mention, not supposed to mention any stock name, but for better understanding, I'm saying this company is having more strength to do such programs, buying back programs, and you will find many other company going for buying back still now, or will come up with the buyback programs to increase the shareholder percentage holding into the company. That means there is a shareholder promoter interest as well as those shareholder will continue. They are having much interest into the company, and buying back means one way or other way to reward the shareholders of the company. Okay, friends, good night. This is all from my side. Next time I'll come up with right issue by the company, and then I'm going to speak some stock. It might be if they are healthy, their balance sheet healthy in nature. Thank you. Good night.